Hi everyone, this is Finance Meets Real Estate. We have Marco Santarelli here today. He's the founder of Norada Real Estate Investments. I believe it's the largest or one of the largest turnkey real estate companies in the States. And he's also a host of a podcast called Passive Real Estate Investing. He's an author as well, and he's an Inc. 1000 entrepreneur. So it's a real pleasure to have Marco here today. So this webinar is going to be on YouTube as well. Afterwards, if you haven't subscribed to our channel, make sure to do so. And with that, I'm going to pass it on to Marco. And again, Marco, thank you for being here today. And I'm really glad to have you on.
Stefan, thank you for the invite. I'm honored to be on your show and happy to be here a few days before the Christmas holiday. So all the people who are actually popping on, I'm very impressed with you and thank you for your time. So is my screen shared? I can't tell from my end. Is it live?
It is, yes.
Okay. Okay, well, I will just run through this and then we'll leave a little bit of time for Q&A at the end so the people who are actually live with us can, ask questions about whatever they like, whether it's economic related or market specific. And then, of course, you're going to repurpose this later. So with that, I'll just move forward. Okay, Stefan?
Yeah, sounds good.
Okay,
sounds good.
Great. Okay, so today I want to just share some of the many reasons why I am bullish on real estate and why you should be too. And I have been bullish on real estate for a very long time. And I'm going to share some of those reasons why today. A lot of people seem to think that we might be in a quote unquote bubble. And unfortunately, the mainstream media likes to sensationalize and create a lot of, drama around the whole thing about whether we're in a bubble or not. And the thing that frustrates me about the mainstream media is they talk about real estate as if it's this one nebulous cloud where we live in this one market inside this country. And I'm going to get into this here in a couple of minutes to explain why that's a very dangerous belief system. So let me just take a couple seconds about me. I know, Stefan, you just covered that, but since I already have the slide in there, I'll just take 2 seconds. Yeah, I am a full-time real estate investor. I'm an author. I'm also the founder of Norada Real Estate Investments. I started that company 18 years ago, and we are a nationwide provider of investment properties. They're turnkey cash flow investment properties. And our company has been on the Inc. 5000 twice now, this year and 3 years ago. So I'm very proud of that. I started when I was 18 years old. I bought my first rental, fixed it up, managed it myself, leased it, and held on to it for a good period of time. And I wanted to start earlier, but I couldn't get started before the age of 18 because I couldn't qualify for a mortgage. But the writing was on the wall and I just stuck to it for many years. And fortunately I did, because the experience that I gained is what I freely pass on to people through our website and our podcast. And I just love to teach people how to be successful in real estate. So I've built a very large portfolio across the country, and it's something I'd like to share. And then, as Stefan mentioned, I'm the host of the Passive Real Estate Investing podcast. It's available literally everywhere you can find podcasts. It's usually a top 50 show, and it's great for people who don't want to be fix and flippers. They want to build a portfolio and gain passive income and create wealth. And so there you have it. I'll show it again at the very end of this presentation. So let's take a look at two things. Let's look at some national trends and start there at a big picture, like a very high macro level, and work our way down. Because I think it's important to understand economics 101, the fundamentals of supply and demand, because they drive the markets. And I want you to understand that I said markets as in plural, not singular, because the country, the United States, is made up of over 500 MSAs, or metropolitan statistical areas. If you start including micro markets and counties, we're now into the thousands. And that's the whole thing, is this country is made up of many, many local markets. And you've heard the expression, all real estate is local. It's absolutely true. Real estate is local by nature. There are some macroeconomic factors that drive and change what goes on. But at the end of the day, the more granular you get, the more you'll understand real estate and you'll understand what is happening in a particular market. So let's look at the supply side of this, the supply fundamentals. Freddie Mac said not just not more than about a year or so ago, within the last 2 years, in some of their studies, that between 2020 and 2030, we are going to have up to a 4 million unit shortage in housing. Now, that is incredible. Now, there's some good news, and there's some lining on the clouds here, which I'll get to in a moment. This won't be as big of a problem as some people seem to think, but it is an opportunity, because we're talking about why are we bullish in real estate. The fact that there's going to be a shortage in housing means that you, as a real estate investor, or somebody who is positioning themselves to be invested in real estate in the right markets, can benefit from this, because that supply shortage will drive property values up. And I'm not suggesting you be a real estate speculator. You don't want to just be in the hopes of being in a casino and increasing property values. You want to invest intelligently and strategically in the right markets, where demand is going to stay strong and supply will be able to keep up with the demand. And that just means that you're going to benefit from cash flow and price appreciation. But the point I'm trying to make here is that we have had for a very long time, and continue to have, a supply shortage. And it is pretty tight right now, and it continues to be that way, although we are seeing improvements. And I'll show you a slide here shortly that illustrates this. In addition to that, just 4 years ago in 2017, we had a 370,000 unit shortage just in that year alone, just to show you how much of a shortage we have at different times throughout the last, couple decades. Again, I'm going to show you a slide that will point some of this out. Baby boomers are staying put for various reasons. One, they just are choosing not to move. Two, it's hard to find the inventory for baby boomers to move to, whether they're moving up or more likely moving down. They're downsizing because now they're empty nesters, their kids have moved out. They don't need the same space, or they're moving because of climate or lifestyle changes. So baby boomers who typically move into either other housing, new construction housing, or just free up some of their existing inventory when they have a second home, are not putting those units on the market. Therefore, we have this shortage of supply, which further perpetuates the problem. And what does this do? This basically leads to increased occupancy on all units across the board, whether rental or homeowner based properties or second homes. It pushes rental rates up. It increases property values, because that's just the dynamic here. It's pushing values up across the board because the supply is so strong. The bottom line is supply is tight. It has been for a long time. It's been a frustration of mine because of the company that I run here, where we have investor clients looking for property. We can find it. We have a great pipeline, but it is about half of what we used to see about 4 or 5 years ago. So we're definitely feeling the pinch, as everybody else is. Now, let's just look at this graphically for a brief moment here. This is a busy chart, but what I just want you to pay attention to is that red line across the top, or across the middle, represents roughly about 1.4 million units per year. That is the long-term average of what we need for supply. And that will carry through 2025 and beyond. Now, I'm going to show you two numbers in this presentation that are very close, but you're going to see that demand has pushed that need up a little bit higher than what we're seeing in this particular chart. But from 2007, we see a drop in the amount of supply that has been coming onto the market, but the demand never went away. And so what we had is a shortage of housing. Now, it's been slowly crawling up, but we still have this ongoing deficit that's been rolling forward. This is the first year in a long time. Did you have a question, Stefan?
Marco, yeah, sir. If I may interject. So what are the labels here? Like when they say single family starts, multifamily starts, manufactured housing starts, sort of as on the demand side, like above a given level, like you're reaching to the further and further markets, or like what exactly is the meaning?
This is on a nationwide basis, the number of housing starts, and it's broken down into single family, multifamily, and manufactured homes.
Defined as what? Like what is a start? Is just for our audience as well.
Yeah, where a builder pulls a permit to create a new housing unit.
Got it. Clear. Okay, good. Mm-hmm.
Right. So from 2008 essentially, and beyond, up until 2019, we've had this deficit. There weren't enough housing starts to meet that demand with the red line of the 1.47 million units that we need every single year. So we have every year a building up, a pent-up shortage of housing units that need to be produced for the amount of demand that is out there of people buying, whether it be investors or homeowners, or even people buying second homes. Now, this year, 2021, we've actually exceeded that long-term average of 1.47 units, a million units. And so we're slowly catching up, and you see the forecast for the following years is going to slowly help us to catch up. Builders, I'm getting ahead of myself here because I'm going to mention this later, but builders have been scrambling to buy land, lots of land, and get permits to prepare themselves to build as fast as they can. And by the way, their margins have been historically high. The profit margins of most every single builder, nationwide builder, has been at historic highs as well. They're doing very well. But they are scrambling to buy land, get permits, and build housing as quickly as they possibly can. So we're seeing a positive trend here, but we're still running at a deficit overall. And that's really the main point. So I'll come back to that and touch on it a little bit later as well. So now let's look at the other side of the equation, demand fundamentals. So again, another study, Fannie Mae, was putting out some research and some data that we need 1.62 million household units per year. That's the demand side of the equation. So you can see that exceeds what I've been talking about before. And let me just move on here. So when you look at this chart and you look at the amount of supply that we've produced and the demand relative to that, we've not supplied enough since 2007. Now, if you remember history, 2006, 2007 is when we had so many speculators in the market that we simply overproduced, and that's when we had all this inventory in the markets, especially in Las Vegas, Phoenix, and southern Florida, where we had a glut of inventory that led to the Great Recession. We had this housing market implosion. There was a lot of speculation going on. Credit was very cheap, and we overbuilt. We actually got ahead of ourselves, and the market couldn't support it. Then when credit tightened up, the house of cards fell down, and we basically found ourselves in a situation where we had a lot of excess inventory, which was a bad thing because it actually affected homeowners and businesses across the board. In fact, it became kind of a worldwide situation. But we have not supplied the amount of inventory we need since 2007. Now, what's happening on the demand side is we have a lot of people coming into the market right now that need housing. We've got Gen Y, the millennials, who have been moving for a while now, but moving into the rental market. There's 72 million of these people, the Generation Y group, and I call it a pig in a python. But this generation has been moving into the rental market. They're also now buying their first homes, and they're creating a lot of demand for housing that is not out there for them. If that wasn't enough of a problem, we have another demographic called Gen Z, the oldest being 23, and still it's roughly a $70 to $80 million demographic. That's another pig in a python. And they're also starting to move out of their home, looking for a place to rent, whether it's with a friend or on their own. But they're just also creating a lot of additional pressure in the market for housing units. And so this is why we're seeing an explosion in single families, multifamilies, apartments. It's very hard to find inventory, especially in great neighborhoods around the country. But being a real estate investor, it creates a compelling problem, because if you're on what I call the equity train, you're now benefiting from the price appreciation and demand, because that's pushing rents up, pushing prices up. It is a problem for those people who are not in the real estate market, that have not created ownership, have bought a property, or are looking for a place to rent, because prices are going up very rapidly. And we're going to talk about raising rents here in a moment. Affordability has become better in the mid markets, which has also increased demand. Now, this is also a function of low interest rates, historically low interest rates. But if you look at the tier one markets, the LAs, the New Yorks, the San Franciscos, they've become overpriced and unaffordable. So people have been moving further and further away from these major metropolitan areas into what I call the mid markets, or what I also refer to as tier two markets. But the affordability has gotten much better in those markets, which has been an interesting dilemma, because all that inventory has been purchased and sucked up very, very quickly. And so now these people are pushing property values up in these tier two markets as well. And so now we're finding this spillover effect where people are moving out of these tier two markets further out into even smaller areas and smaller towns, sub 100,000, sub 50,000 in population, and pushing prices up very much there. I personally have property in areas like Beloit, Wisconsin, very small markets you could call a micro market, and we've seen property values go up almost 30% in some of the areas that I'm in within 2 years. I mean, it's just incredible. So demand is very strong. Supply is tight, demand is strong, and it's creating a very interesting situation for people, whether you're an investor or a homeowner. Now, back in 2015, a colleague of mine, John Burns, released a book called Big Shifts Ahead. Some of you may have heard of it. It's a very good book. I highly recommend reading it. Back then, they did a 10-year forecast, and they forecasted that between 2016 and 2025, we would need, on average, 1.37 million homes per year. If you notice, this number is very, very close to the two numbers I talked about in the previous slides. And so it's always in the 1.4 to 1.5 million range. Interestingly enough, their calculation, which they basically took the number of households that need to be formed, which is 12.5 million people, added the demand, the ongoing demand of 500,000 new second homes required every year. They added the number of teardowns that were historically being what's the word? There's just 2 million teardowns every year, and they removed 1.3 million excess vacant homes. That calculation was pretty accurate back then, and it proved to be accurate from 2016 to 2020. It was about 1.37 million per year. They were right on the money. As it turns out, in 2021 and going into 2022, we have now looked at those numbers for 2021, and we now need more than 1.5 million homes per year. So it still was a great calculation, but what we're finding is that we actually need more homes now than we needed before. So we need more than 1.5 million homes per year, and that's probably going to continue for the next 5+ years. And like I said before, builders are scrambling to meet this demand. In fact, single-family permits that were pulled this past year rose 20% over a previous year. And so that is an incredible increase. Builders are not stupid. They're dialed into the market conditions and the data that's out there, and they realize that there is a massive shortage. So they're working to pull as much land and permits that they can in order to fill this demand. So 1.5 is that new number. If you remember that red line across that graph, that is now bumped up a little bit. So here's the situation. Well, I put a red X here and I didn't actually pull it up before, but the situation is this: that excess inventory of those vacant homes are now gone, and it's pushing this number up, and that's why it's gone over 1.5 million. And who knows, maybe 12 months from now, we'll look at this again and we'll see that maybe we need 1.6 million, but time will tell. Now, here's a concept that you don't hear very often. If you remember back in 2008, after the Great Recession, a lot of banks had all kinds of foreclosures on their books, what they referred to as shadow inventory. These were properties being held by the banks that weren't being pushed onto the market at that time because they either couldn't or didn't want to. And they also didn't want to put a glut of inventory on the market right away with all the excess inventory, which would essentially crash the market. So we referred to that as shadow inventory. It was inventory that was there. You don't see it, but you know it's there. Well, there's a similar concept now called shadow demand. And these are the people, the young adults that are living at home. And these are people between the ages of 18 and 29 that are living at home, living with their parents, or bunked up. And if you look at the last 100 years, we peaked after World War II in the 1940s, where we had 48% of young adults living at home. And then ultimately they moved themselves out into the markets, and they found places to rent or found places to buy and become homeowners. But now we've got 52% of these young adults living at home that will ultimately need to leave home and find a place to rent or a place to live. These are people who are looking for more space. Sometimes they're cooped up because of COVID. COVID, anecdotally speaking, has led to an increase in divorce rates because people are, husband and wife or couples are, together far more, and they maybe are getting on each other's nerves, whatever the case is. But these people are moving out into the market. So this is shadow demand. It's there.
Marco, just a quick question. So do you know what drove that increase, let's say between 2000 and 2020? I mean, other than, let's say, effects of COVID now.
Yeah, that's a very good question. I don't actually know why there's an increase in the young adults staying at home. It could be, I'm only guessing at this, but it could be in part because of affordability issues, people staying in school longer. More recently, obviously, we're talking about the 2020s here, but related to COVID. So I'm not exactly sure. I'd have to go and pull this report. It's it comes from Pew Research, the Pew Research Center, and so what
that's
we do
pretty
know,
interesting. Okay.
Yeah, it is, and so I just refer to it as shadow demand. The takeaway, though, is that we have, over the last century, an historically high number of young adults still at home that are not going to stay there forever. They have to get out into the rental market or become homeowners at some point. And so what's going to happen when these people start to move out? I mean, it's pretty obvious that they're going to start putting more demand pressure on the whole supply demand equation here, and add more pressure to the tight market that we have today. So it's just an interesting thing to keep in mind. And again, the topic is, why I'm bullish. Well, this is a reason why I want to be in the market, not on the sidelines watching, the real estate markets become tighter, which means that rents are going up and prices are going up. I want to participate. I want to be on that equity train. And so, to kind of summarize, the last four slides or so, we have these fundamentals where supply is very tight. We have a shortage. Freddie is expecting a shortage by the year 2030 that we're not going to meet. Demand is very strong. We've got Gen Y and Gen Z coming out. We've got this coming shadow demand, and we have historically low interest rates that will remain low and is expected to remain low for the foreseeable future. So that just translates into a situation where home prices will continue to rise. And now I will say they are not likely to rise like they have for the last 12 to 18 months, which has been an absolute anomaly, especially when we're seeing 20+% appreciation rates in many markets around the country. That won't happen, but we will see that pressure continue to push prices up. Now, just let's look at some kind of random, if you will, pieces of data here. Home builder confidence is interesting because it shows the sentiment of both home buyers as well as consumers. And actually, this number is higher now than when I put the slide in here. It's more like 83, 85. But these feelings of optimism are essentially supported by a wave of new home buyers that have been coming into the market. So anything above 50 is considered very positive sentiment, and we have been historically high over 80. If you actually look at the slide, you can go back to 1998 where we were just under 80, but we're somewhere in the 83 to 85 range right now. So this is the highest rate of confidence in the housing market since 1998, and actually even before. Recovery of payroll job losses is interesting too, because there were a lot of job losses during COVID, and with a lot of these markets now back to 100% employment, the recovery of these jobs has been good for the economy. It's the increased the labor participation and the GDP of these markets. But some of these markets, a lot of these markets actually are still lagging behind. And one of the main reasons for that is because of this so-called labor shortage that you're hearing in the media often right now, it's holding some of these markets back. It's not that the jobs aren't there or employment opportunities aren't there. There's a lot of people who are either A, not available to work because they just don't exist, or B, they're opting out and not working, or they made a career change, or they moved, or, you know, sadly over the last year, a lot of people have been taking advantage of employment benefits, and were actually able to make more on unemployment through benefits than they were at their jobs. And sadly, I know a few of these people, but anyway, there has been a tremendous recovery, which is good, but there's still some headwind in terms of the available skilled labor to fill jobs in some of these markets, which will just create a bit of a drag on that market. So we all know that real estate is a great inflation hedge. I love real estate because it is a great inflation hedge. You know, if you think about what real estate is, it's sticks, bricks, copper, and concrete, all built together as a package on land. And so even though land values change, these commodities that are put together as real estate, what we call improvements, are essentially hedges against inflation. They go up and down as inflation adjusts. So the interesting thing here is that home price appreciation over the last year has been an absolute anomaly. It's been incredibly high, beyond anything we've seen in history. And that has been good as an inflation hedge. Rents have also been very, very strong. Clearly, they don't follow in suit with, unfortunately they don't, but they don't follow suit with price appreciation. But if you believe what, you know, the government bodies tell you in terms of the inflation rates, you know, being between 4.5% to 6.9% more recently, which has actually been the highest in the last 40 years, which is crazy. You'll know that inflation is really high. I mean, if you're a shopper, you know inflation has been very high. In fact, a lot of reports out there are showing that inflation has been in excess of 15%. But that would also help to explain why home price appreciation has been so high. Home prices rose over 19% on average across the board nationally. And I don't like talking about real estate in national terms because real estate is not national, it's a local phenomenon. But if you look at some markets like Phoenix, prices have risen 32%. Austin, Texas, 32% plus. It's been very, very unusual in terms of price appreciation, and that is certainly not sustainable. But the point here is that real estate has always been a great inflation hedge, and that's why a lot of investors invest in it, because they know they can protect and preserve their investment capital as well as grow their equity and create wealth that will keep up or exceed the real rate of inflation, not the nominal rate of inflation. Rents tend to lag behind, but they also appear to be very strong. And there's been a high correlation as well, if you can see in the earlier part of this chart, between the three. But they kind of broke off in the early 20s when we saw this rapid rise in property speculation across the country. And then, of course, the Great Recession dropped that down. We kind of normalized in the mid 2015 range. But then more recently, you know, with all the stimulus printing, we saw inflation really rise because there's just been a tremendous amount of new capital or currency being created by the Fed and put into the system. In fact, we've created about 80% of all the currency ever created in the last, 12 months or something like that. Insane money printing. But again, you know, the takeaway is that real estate is a great inflation hedge, continues to be a great inflation hedge, and probably always will be, because again, it's commodities on land, and that's the important thing. I want to touch on interest rates here. Interest rates, mortgage rates specifically, are at historic lows. They have been for a long time. They've continued to kind of be year after year reaching new historic lows. The expectation of interest rates rising over the next 12 to 24 months is very, very low. We can see a bit of a change. There are arguments for and against raising rates. We certainly don't want to disrupt the housing market. We want it to be very healthy because it makes up a very large percentage of the country's gross domestic product. But the question I have is this, if you look at what happened to interest rates from 2017 to 2018, they rose 55 basis points. And what do you think happened in housing in general between those 2 years? The answer is almost nothing. There was very little change. So what would happen if we saw another 55 basis point rise from what we see today in 2020 or 2021 to 2022? Probably very little. So interest rates might change. They probably will, but I don't see interest rates changing all that much, especially over the next 24 months. And if they do, it probably will have a minor impact because the forces of supply and demand, especially on the demand side of the equation, is going to be far stronger than what interest rates are going to create as far as an impact. Yes, it does change the monthly payment. Yes, people buy based on monthly payments, their affordability, not the purchase price. But there's still so much demand, even with rising prices, that we're still going to see strong demand and a healthy housing market moving forward. Again, I'm talking in somewhat general terms here. We have to understand that what happens in a tier 1 market like San Francisco, which is very expensive and unaffordable, is different than what happens in Kansas City, which is different than what happens in, let's say, a Detroit, Michigan. So you have to keep that in mind as well. Consumers, as in borrowers, continue to qualify without problem. Optimal Blue, tracks the debt to income ratio of purchase loan originations across the country. In fact, they represent about 30% of all loan originations for single family homes and townhomes. And so when you look at the number of transactions with the debt to income ratio that's over 42%, kind of that threshold for Fannie and Freddie, it's still very, very low. It's only about 32% of those originations. So people are actually qualifying without a problem. In addition to this, I will comment that the average credit score for those that are borrowing, in other words, getting new mortgages, has been around 720. So it's not that we're giving loans to people who can't qualify, legitimately qualify, and they have poor credit or low credit, such as a 680 score or a 7, or like a 620, a 640 like it used to be. People that actually have high credit scores and good credit profiles, and we're talking 720 scores and above. So these are well-qualified borrowers, and that's a very good factor to consider, because the health of the housing market, especially in harder economic times, can be affected by people who actually don't have the ability to afford and are really stretching themselves because they don't have the debt to cover the debt service of the properties they're purchasing. So this is actually a very good sign, a bullish sign, if you will. The single family rental home market value is over $4.4 trillion right now, and it continues to grow by the month. And this is an amazing statistic, because it's more than doubled since the 2.2 trillion level in 2010. So in about 10 to 11 years, the market value of single family rental homes has more than doubled. And that's to a large part, obviously, appreciation. But why am I bullish? Because if you were, took the opportunity and recognized what was available in 2010, 2011, even 2012, which is pretty much where the bottom was in most markets around the country, is 2011, 2012. You could have invested in real estate, ideally as much as you can or could back then, and rode this appreciation wave, this equity train, and essentially created more than double, the equity in that home that you would have started with. So real estate is a great investment for so many reasons. There are essentially 4 pillars to it, but you can see just from an equity perspective what real estate can do over the long term, even with the ebbs and flows that happen from year to year. So I thought this was an interesting slide to include. There's many slides that I actually excluded from this presentation. As we kind of start to wind some things down here, I want to just point out some markets on an affordability index scale. And these are not all markets, of course, in the country. These are just some of the markets we track. There's about 63 core markets that we track. There's about 130 or so markets that we track on a broader scale, but we have data on over 500 markets. As a company, we're only in about 25, and those 25 are similar to the ones in green at the bottom. In fact, many of those markets in green are the markets that we are active in, meaning we have boots on the ground and our investor clients are purchasing investment rentals, turnkey rental properties in these markets, and that's what we're providing them. But the expensive markets should not surprise any of you as being very expensive, like San Francisco, San Jose, and Los Angeles. Even where I live here in Orange County, it's considered, very expensive, meaning low affordability. But what you will see in common with a lot of these is they're coastal markets. And that's the issue around the United States, is most of the coastal markets are very unaffordable. There's high land value, which is the downside risk when you're investing in real estate. And they're also more cyclical in nature in terms of their price changes, although we haven't seen as much of that recently. But these are the expensive markets, is the coastal markets. As you go further down the list, you'll see that some of these markets are markets that have appreciated a lot over the last 2 to 4 years. And as you go further down, these are more linear markets in nature. They don't tend to fluctuate like a roller coaster up and down, but they make more sense from a cash flow perspective, as well as a more smooth price appreciation perspective. And we happen to like, these markets like the greater Chicago area, Atlanta, Dallas, Indianapolis, Philadelphia. We do a lot of business in these particular markets. We love them from an investment perspective. And they're great for renters, they're great for homeowners, they're great for investors. Rental occupancy rates. This is kind of the section where I just want to point out that rents have been strong. They have been increasing year after year. Right now, they're the highest they've been since 1995 in terms of occupancy. In fact, this slide is a little dated right now. The occupancy rates are probably closer to 98%. So the demand for rental homes has pushed occupancy levels past historic averages. The average used to be 95.1 just earlier this year in Q2, but as of right now, it's probably closer to 97, 98%. Very, very high occupancy rates, meaning that people who are out there looking for rentals are having a hard time finding them. And when they do find them, they are finding that rents are basically at market. They're very high, and they're the highest they've been in a long time. So sometimes it actually makes more sense not to move than to actually move, which is a segue to this next slide here. Single family rent growth. This is the year-over-year national changes. What we're seeing in the third quarter of this year is that renewals, people who are renewing their lease and staying put, are seeing an average, and this is nationwide, of an 8%, about an 8% increase in their rents. However, when a landlord has a property and a tenant moves out and they actually have a vacancy, when they can fill that vacancy, they are finding that they can increase their rents about 14% on a vacant unit than they can with a renewal. So there's an arbitrage opportunity there. In other words, it's a 6% increase opportunity for landlords to actually not renew a lease and let the tenant move out and then bring in a new tenant, because they can push the rent increase to the maximum, and that gives them a larger opportunity by about 6%. And this is actually happening with some of my properties in Florida right now. I've been able to increase rents from about $1,100 to $1,400 on turnovers, which is phenomenal. So I obviously can't complain about that. And then just wrapping up the rental part of this is that we're seeing rents increase tremendously across the country. In fact, just the 63 markets, the core 63 markets that we're tracking on this slide, we're seeing rents increase between 7 and 8%. Kansas City, one of the strongest rental growth markets, has increased 7.7%. Memphis, 7.5%. These are year over year. Tucson, Arizona, 7.4%. You'll notice that most of these are like light to dark green, which means that rents have increased between 5 and 10%. And we're seeing this to be very common, even in some of the other markets that are not shown on here, and a lot of the tier 2 markets that we operate in. Rents have increased between 5 and 10%. And there are many markets where we've seen that increase 15 to 20%. If you look at Jacksonville, Florida, for example, I have properties just south of there. Many of the submarkets in Atlanta, we're seeing rent rates increase double digit, again, over 10%. So this trend is continuing and will continue into 2022 without question. It won't necessarily be as strong as what we're seeing this year. But again, you know, the rents on vacant rental homes this year has surged by as much as a whopping 29%. Now think about that, 29%. And I'm actually living proof of that. My properties in Florida, we've had 30 to 40% rent increases over the last 12 months, which I know sounds insane, but it is what it is. Okay, and then just to wrap things up here, I actually borrowed this slide from First American Title. These are some markets offering some of the highest returns. Now, I'm not sure how they calculated cap rates here. These numbers actually don't make sense to me. I'm not sure what they're including in their calculations or their formulas to make these calculations. But if we just look at this on a relative scale, on the far right, you know, whatever's in blue, obviously, again, are coastal markets and markets that are overpriced and don't make sense, like New York, Seattle, San Jose, and Los Angeles. These have the most compressed cap rates, very low cap rates, and they don't make sense from an investment perspective. However, as you go to the left and you get into the darker greens, Pittsburgh and the Pittsburgh market is actually one of our top markets right now and has been for the last 12 plus months, because cap rates are very strong, appreciation rates are very healthy. We are in 3 markets in Alabama, including Birmingham, which you see there. Again, we move a lot of product there, very strong cap rates, great cash flow, strong cash on cash returns. Still a healthy and what I'll call a more normal, quote unquote, rate of appreciation. Same thing with Memphis, but you can see, you know, a lot of these markets offer better opportunity from an investment perspective if you are looking to invest in real estate. So, you know, I like to refer to these as linear markets, also tier 2 markets, and Indianapolis has been a perennial market for us as well. So you can get a feel from this slide, you know, where the opportunities are and where the higher risk markets are, which are on the far right in the blue. Now, I'm just going to leave you with some thoughts about, you know, 2022, you know, my comments, my forecast, my predictions about what I see coming and what the data is showing. This is more data-based than it is opinion-based. And it's really data and trends that you need to look at, which will really, really help you. So 2022, interestingly enough, will start with an 18% increase in the government-sponsored entities' standard loan limits. That's essentially the, you know, maximum loan amounts that Fannie Mae and Freddie Mac will offer for conventional financing. The interesting thing about this is that these loan limits are increasing, which allow more borrowers to get conventional financing to buy property, which means that the demand will continue. The demand will still be strong. There won't be resistance or a bottleneck in terms of financing to acquire property. And this goes into effect in January. It's already news. It's on the books. It's baked into the cake. It's going to happen. Even FHA loan limits are going to be increased by 18% across the board. In fact, some of the more expensive markets, like where I live here in coastal California, are going to be even higher than that. So you can see the loan limits for Fannie Freddie are going to go up to $647,000, $420,000 for FHA. So this just opens up financing to more buyers across the country, which means that there's going to be more liquidity and the ability for people to buy real estate, which just keeps credit flowing on the demand side of the equation. Expect another 5% or more in existing home sales next year. So sales are still going to be very strong. Construction is expected to increase 6% next year, which will allow us to get almost 1.8 million new starts, and that includes the manufactured homes that you saw in that earlier slide. Expect single-family rent growth to match the recent headline inflation, which I don't believe, but the headline inflation more recently was 4.9%. We're going to see rents to, you know, continue to increase. I think it'll be more than that, more than 5%. That just seems like a low number coming off of the year like what we just saw this year. But the point is that rents are going to continue to increase. And rents will keep growing quickly because we still have very high occupancy levels, as I talked about. Tenant income growth is still growing. Rents income is growing across the country. In fact, a lot of employers are competing aggressively with each other in order to keep employees, as well as to get the interest of other employees that are not working for them yet, because they have spots to fill. So they're basically creating very attractive positions with high starting rates and even bonuses to try and attract these people. So tenant income growth is there. And also, a lot of landlords have spent years not pushing rents up to true market rents. And I'm an example of that with my properties in Florida, where there was an opportunity to raise rents, and I was doing it slowly or not doing it at all because I had tenants in place that I didn't want to move out. So I just left rents the way they are. But as these tenants moved out, I was able to raise the rents 20, 30, even 40% on some of my units. There's a strong degree of optimism. It's continuing as it has been for the last 2+ years. This is continuing into 2022. And we see this with pretty much every single new home builder across the country. They are very optimistic, and they're so optimistic that they are going, I don't want to say a phrase that I would love to say, but they're just going all in, if you will, on acquiring land, as much land as they can, so they have buildable lots for the foreseeable future. We're going to see high single-digit growth in rents and volumes. As I mentioned, sales volumes is what I meant there. And we can expect home prices to rise at least another 8.8% across the board on average next year. Some markets are going to be much more than that. Some markets are certainly going to be flat. And sadly, there's going to be no relief with the labor issues that we are seeing. This is going to continue for the foreseeable future, probably the next couple of years. But the bottom line is here that the rewards of investing in real estate for 2022 and into 2023 will certainly outweigh whatever you see as rising risks. The thing is we have a lot of tailwind and we don't have a lot of headwind. So it's still a very opportunistic time. And if we have time, Stefan, I can just run through this slide here, a couple tips for people who are
absolutely.
Yeah. Okay, so this compresses a whole other presentation into one slide, but I'll just kind of summarize it for you. This is our own philosophy and general mode of operation in our company. This is how we operate, and this is the counsel we provide to our clients all the time. You want to pick markets that have lower downside risk, which means they don't have high land value or land costs. The higher the land costs, which goes back to the coastal markets that we were talking about, California, New York, New Jersey, and all the way up the coast. Those are markets that have higher downside risk. So when you have high land values, you want to try and avoid those markets. Besides, they're also very unaffordable, and the rent price ratios do not work in those markets. You want to stick to markets that have strong job stability or ideally job growth, because that leads to a healthy housing market. You want to pick markets that have positive migration, net migration, because that, again, feeds the demand side of the equation. If you have more people moving into a market, it increases demand for housing, and those people need a place to live or rent. And so positive migration trends lead to strong, healthy markets that have price appreciation, both in rent and price. You want to pick markets that have rational rent to price ratios, which means that the rent versus the purchase price or value of that property provides you with a favorable cash on cash return and the ability to service the debt and cover all your expenses. Some of you may have heard of the 1% rule. That doesn't necessarily apply today as much as it used to, let's say 4 or 5 years ago and beyond. But all that meant was this: if you bought a $100,000 property, the 1% rule says that it should rent for about $1,000 a month, 1% of the market value or purchase price. That doesn't work as well today unless you're in a tertiary market or you're in a C-class neighborhood in a tier 2 market. So generally speaking, a rent to value ratio of about 0.8%, 0.9% still is very good. It's healthy. The numbers will pan out. You'll do fine. If you can hit 1%, fantastic. We still get 1% in some of the markets, like in Pennsylvania. We have a lot of our clients purchasing there. In the Alabama markets, we can hit that 1%. But try and come as close to it as you can, but don't cheat yourself. Don't go into C or D class neighborhoods just to get that 1%. You're going to pay for it later. It's going to be a thorn in your side having rental properties in those types of neighborhoods. Pick markets with available inventory. I know this is a challenge across the board. In fact, there are literally builders, new home builders right now that have a recording when you call that says, if you're calling about investment, if you're an investor or you're calling for investment property, we do not have any inventory available for you. But if you still want to, if you're still looking for a home, stay on the line, we'll help you. So builders are actually turning people away because there is such a tight amount of supply in the pipeline right now. And lastly, take a top-down approach. A lot of investors make the mistake of looking at a property that looks like a good deal. It's been renovated and they like it, whatever the case may be, but they are looking at the tree in spite of the forest, and it should be the other way around. Always start with the market. You know, take a top-down approach, start with the market, work your way down to the sub-markets, then look at the neighborhoods, and then start looking at properties along with the team that you're working with around you. If you take a top-down approach, you'll mitigate most, if not all, of your risks. So always take a top-down approach, and that's what we recommend to clients all the time, and that's our methodology. And just wrapping up, kind of a 2 freebies, if you will. Everything I talked about and more is condensed in a 30-page primer that I put together. It's a free download. It's the ultimate guide to passive real estate investing. You can download it. There's no obligation. It's what we just talked about, plus or minus. And as Stefan had mentioned, you know, I'm also the host of the weekly passive real estate investing podcast, which is available everywhere. And, you know, it's just another free resource. So that is pretty much it, Stefan. I did talk very quickly because I tried to get through a lot of information as quickly as I could for you.
Yeah, that was really great, Marco, and I took plenty of notes myself, which is nice. And we have a few questions on the chat already, actually. I can relate those over. So first question from Jagdish. So if the numbers on the graph are nationwide and don't, well, actually, I assume that was on the some of the supply demand graphs at the beginning, so are nationwide and don't differentiate between demand from owners versus demand from renters, and the overall population is not increasing at a drastic rate. Where is this persistent demand coming from? Is it just coming from young people moving out of their parents' home?
That took into account all sales. So it's investors, new homeowners, second home purchasers. It's everybody on the demand side of the equation. It didn't split anybody out. But let's just say that in some markets, investor demand, meaning sales, are as high as 30% of sales. Like if you look at Phoenix and Austin, and there's one other market, I want to say Vegas, but don't quote me on that. But I know Phoenix and Austin, about 30% of home sales are from investors, meaning they're non-owner occupied homes. They're people purchasing a home for the purposes of renting it out. It's a rental property. So you have to keep that in mind. It's very much you know, market specific, but that slide took into account all purchasers, whether they're investors or homeowners.
And thank you for that. And Kati is asking, if demand is high and prices are up, won't we be positioned for the typical 10-year price slump as the housing starts to catch up? Some are worried about buying too high and having to sell having to sell or rent lower once the peak is hit. Just curious about your views on that.
So the question is there a concern that we're past like a 10-year quote unquote cycle?
Well, sort of, I guess the question being if demand is high and prices are up. Yeah, I mean, I guess sort of like passing the, if you'd like Kati actually to speak up.
Yeah, I'm here. So, so, you know, the conventional wisdom is you buy low, sell high, right? And obviously the prices are at a historic high. So as an investor, I'm looking at, how high are they going? And are they going to stay high? Or are we going to have a dip like we normally do every 10 years or what, it's a cyclical thing, right? So I just, the affordability for everyone, including investors, is pretty difficult right now in most markets. So I just wondered what your thoughts were. Like, are we at the peak of this rise, or are we only halfway up, or, is there money to be made more than in the next 2 years or 3 years?
Kathy, that's a great question. There's so much to unpack there. We could literally spend an hour. No, it's okay. Let me give you some food for thought. Let me give you some stuff to chew on here. First of all, prices can continue to go up as long as those prices are affordable, meaning that, think about it this way. If prices went up year after year after year forever, people can still afford to buy that as long as their incomes kept up, with that price appreciation. So as long as the affordability kept in step with price growth, then prices will continue to go up. Now, will that happen? Not likely, because there's so many other factors. You've got mortgage rates to deal with. You've got the rate of real inflation to deal with. Part of the reason we saw prices go up so much over the last 2 years is twofold. One is liquidity. Credit is easy to, interest rates are low, credit is available, and people can afford it. As one of the slides showed, that people are able to actually qualify. The other factor is that with the amount of money printing, as they call it, that's been going on over the last 18 plus months, that capital has to go somewhere, and it's flowing into the economy and into people's hands, and it's giving them, the ability to buy property. Incomes are going up. They've gotten free money from the government. Whatever the case is, as long as there's that liquidity, we're going to see inflation. Inflation is a good and a bad thing at the same time. We live in an inflationary environment. We can't live without it, because our financial system, the system itself, is based on credit. And in order to service that credit, we have to keep printing money. That's just a fact of life. It's the way our economic system is built right now. But so that means that prices across the board, whether it's gas, food, clothing, housing, school, whatever, prices will continue to increase, because we're debasing our currency, and so that inflation is there. The key is that incomes have to keep up. As long as incomes keep up, people will continue to be able to afford it. That's one part of the price appreciation formula. The other part of it, the other piece of that puzzle, is supply and demand. What we've seen is demand is so strong and supply is not keeping up, that it is just economics 101. It's pushing prices up. And so we're seeing appreciation exceed the real rate of inflation. That's what we saw in the last 12 months. We've seen prices in some markets go up 20, 30% more, and that's exceeding the real rate of inflation, let alone the nominal rate of inflation. Are certain markets in bubbles? Absolutely. If you look at a lot of the coastal markets, the tier 1 markets, affordability is very, very low, and that is what I would refer to as a bubble market. But then you got another dynamic at play here, and this is why it's such a complex question that you're asking. Those markets have such limited supply of land that there's no more room to build. Anything that is built is being built at a premium. Land values are very high. Construction costs are on a price per square foot are very high. When you combine it all together, those properties, whether it's a single family home or even if it's a condominium or an apartment complex, are going to be very expensive. And so the coastal markets are very expensive. The large markets and the tier 1 markets are very expensive. The tier 2 markets are not as expensive, but more affordable to more people. I'm just going off in 10 different directions here, because you had so many things in your question to unpack. But as an investor, the
thing is, normally these peaks come down eventually, right? They level off, and I understand all the dynamics that are driving everything up. But the question is will they continue infinitely to drive things up, or are we just going to see another peak to the roller coaster and a slide down. But, like it's the downward slope that's hard to predict and that is most dangerous to an investor, right?
Right. So my advice to anybody looking at it that way is this: is it sustainable? First of all real estate is local, so it's not sustainable, but of course it's market specific.
Yeah.
Okay. Let's just make that clear.
Yeah.
As an investor, I would look at markets that have affordability, have inventory. It's basically the slide I showed before. In fact, I'm going to rewind back to it. So if you look for these things, the job stability, positive migration, healthy rent to price ratios, those are the markets that will have longevity and sustainability. Those are not going to be bubble markets. Those markets will continue to be healthy and thrive. When the dynamics of supply and demand are way out of whack, you won't have inventory, or you're going to have too much inventory. And those are markets to avoid, unless you're looking for the bottom of a market. Then you want to be in a market where there is a lot of supply, because now it's a buyer's market. You can buy cheaper, and be able to position yourself in a market that you, based on your research, expect to improve in the years to come, because jobs will come back, people will move back in, or that market will grow. Which kind of leads to, this is a whole conversation in itself, but that leads to kind of my next point, and that is this. There's a concept I refer to as your cash flow being the glue that holds your deal together. And so as long as you're investing in a market that meets these bullet points that I have on the screen, and you have positive cash flow, and it's real cash flow, it's not that you have a unique situation where you've pushed rents beyond what the market will support. As long as you've got that positive cash flow, you've got what I call the glue that holds your deal together. So what happens is, over time, month after month and year after year, you have positive cash flow, and you have a cash on cash return on your invested capital, and you allow that property to grow in value, and your tenant to pay off your mortgage, which amortizes your loan and increases your equity. So your equity will grow month after month, year after year, because you're amortizing the loan, and your property values will go up because you've got these dynamics in place with jobs and migration. And so that's why cash flow to me is so important. Even if it's zero, like let's just say it's a break-even situation, but that's temporary, it's only for a year or two, that's okay. If you're in a market and you're in a sub-market and in a neighborhood that has strong appreciation potential, because now you've got that wealth creation happening for you while you are still able to service your debt and carry the property. That's why cash flow is so important. I call it glue. But you're not going to do that in San Francisco or LA or New York, but you can do that in so many of the other markets, the smaller markets, the tier 2 markets, the Alabama markets, many of the Pennsylvania markets that we're in, the greater suburbs of Chicago that we're in. There's reasons why we're in those markets. Now, granted, they're also appreciating rapidly beyond their historic norms. But are they in bubble territory? No. Is affordability dropping? Yes. Is it in a danger zone? No. Is it something to keep an eye on? Yes. Is it okay to get into those markets now? Sure, because you've got years for runway. Short of a black swan event or something crazy happening, you're gonna do fine. But if those markets don't, if you're in that market and those markets don't make sense, 3, 4, 5, 6 years from now, if you've got the equity, you could do a 1031 exchange and move your equity out of that market tax-free and put it into another market that is earlier in its cycle, earlier in its growth cycle. And this is where you just, keep track of markets and where they're at in terms of affordability and in migration and, that rent to price ratio and available inventory, the job health of that market.
So in a way, what's on this slide and what you're saying is a tried and true strategy, regardless of all of those graphs that are going way up and to the right. Even if they were going way down to the right, in a way, you're still looking for these things: job stability, positive migration, rent price ratios, and inventory, right?
Kati, I'm sorry to interject. If I may add actually to Kati's question, Marco, because you did mention you had a significant portfolio in 2004. So like, what were like some of your takeaways at that time? Like, how did it go back then? And like, what was your like sort of like in terms of market selection, property selection, and kind of tying to the slide that we have at hand? Are those some of the lessons that you learned back then as well, or yeah?
Yeah, one takeaway, and this I will openly admit was a mistake that I was making that I didn't know I was making until after the fact. But one of the markets I was investing in was in Detroit, Michigan, and some of you might be rolling your eyes saying, "Holy crap! Like, what are you doing there?" What was happening where people were moving back into the city? There was slowly, but migration back into the city. And there was a lot of money, like to the tune of hundreds of millions of dollars being put into the downtown core. There was a complete revitalization of the downtown, and large companies, employers were moving there. Hard Rock was building a place, or had built a place. There was a lot of good things going on. And maybe I was way too early in that trend, but I was picking up a lot of properties very inexpensively, which would have been okay if I was buying down by the Riverwalk or closer to the downtown core. One of the mistakes I was making is I was not sensitive to the quality and how incredibly important the quality of the neighborhood is. And I was investing in properties that were in what I'll call C minus, and maybe D class neighborhoods. They were inexpensive, meaning cheap, which was attractive to me. I could buy a lot of them. But the thing I missed out on, and this is something that we obviously don't allow our clients to do. It's one of our many rules when we're counseling with people, is not to invest in D-class neighborhoods or even C minus, or sometimes even C. I mean, kind of our starting point is for C plus, which is kind of the better end of the low income neighborhood spectrum. Most of our properties that our clients purchase are now in like B plus, and A minus neighborhoods. And the reason I point that out is because the quality of that neighborhood has a lot to do with the potential risk and the amount of brain damage or headaches you're going to have from that tenant demographic and that property. That doesn't mean the property is in poor shape. Often it can be in great condition, but it just happens to be in a bad area where, number one, you're going to have a poor quality tenants, and number two is when you're in these lower end neighborhoods, you don't tend to see the appreciation potential that you would have if you were in an A class neighborhood or like a B plus type neighborhood. So the market is important. See at the bottom there, I say take a top down approach. Start with the market, which is everything, all the bullet points above it. Then you look at the sub markets or the areas, and then you look at the neighborhoods. And I would say that 70% of your headaches and your risk mitigation happen at that neighborhood level, because you can be in an average or a mediocre market that is not experiencing a lot of growth in price or migration, or has a very strong job environment. Maybe it's just stable. But if you're in the best neighborhoods within that market, you're going to do very well, because you're definitely going to have good cash flow and cash on cash return. You might not see, impressive appreciation rates, but it will over time definitely keep up with the real rate of inflation, because it has to. It just has to. You can't build new housing in a market at prices that were on the table 2 years ago. The commodities, the sticks, bricks, copper, and concrete that you're going to use to build new construction in the market has to be at today's prices. And so that will help drive the market. And so I put a lot of weight in the neighborhood and the neighborhood quality. And so that's the main point I'm trying to make here is market is important, area is important, neighborhood is critically important.
Yes, and thank you for that. And so next question, since we're over time, and Marco has been incredibly generous with his time here, and it's been really a wealth of information. So Seth is asking, what's the plan when supply crosses demand in 4 or 5 years?
Say that again, please, Seth.
What is the plan when supply crosses demand in 4 or 5 years?
Again,
assuming it does.
Well, that's assuming it does. I say that supply probably won't exceed demand for probably closer to 10 years, because we'll probably start reaching a point of equilibrium in 5 years, based on the number of permits being pulled by all builders across the country. what they have in the pipeline right now will meet equilibrium in about 4 to 5 years. Some markets more so, like Austin is a market, for example, that will be overbuilt. There are far more permits being pulled than the demand curve or demand trend in that market. So certain markets will certainly be overbuilt, like Phoenix and Austin. So be very careful investing in those markets.
Thank you.
But you're welcome. But I don't think I finished answering your question. So if you go back to my one concept, if you buy right from the beginning, meaning that you have positive cash flow and that's sustainable, and you're in a good neighborhood that will always have appeal, demand. In other words, it's a desirable neighborhood. People will always want to move there or live there. Then you've got protection. You've protected your downside completely or to a large degree. Again, cash flow is critically important. If you've got positive cash flow and that property can support itself through good times and bad, you kind of don't care what property values do or what supply and demand dynamics do all that much, because you can weather through down cycles and up cycles. That property will just continue to support itself, and the equity will grow through the amortization and through appreciation over time on average. So again, this is why I stress not speculating and being in a casino. Buy because you have appreciation potential in a good market, in a good neighborhood, but you also have a positive cash flow to weather through the storm and be able to carry that property through. Again, it's the glue that holds your deal together. Your deal will create wealth through growth and equity over time.
On that, Marco, is actually our next question. So when you say like on that positive cash flow, so what is your average cash flow on a single family residence? Is a question by Constantine.
That's very much market specific, because you can buy new construction homes in Florida, which we have a lot of, in 5 or 6 different markets that don't look very sexy when you actually include vacancy allowance and your maintenance and reserve. Even though it's new construction, you still budget for those things. The cash flows don't look all that sexy. It could be, I'm just making this up because again, it depends on the price point and the location. But let's just say net, when you budget for everything, you're roughly $100, $150 a month, true net cash flow. That doesn't sound like a lot, but what you have to keep in mind is that what you're seeing in terms of price growth and appreciation blows that out of the water. Like you can have a total return on investment of 20, 30% per year or more on those properties because of the equity growth, even though your cash flow is low. But you look at some of the cash flow properties we sell, like in the Alabama market, the Pennsylvania markets, the Baltimore market, the greater Chicago market, we have a variety of both. Those are going to have higher cash on cash returns. Those can cash flow $200, $300, $400 a month or more on a property that's anywhere between $100,000 to $180,000. So that's great cash on cash return. But you're not going to have as much on the appreciation side of the equation. So it's kind of a give and a take. You've got cash flow markets, you have growth markets, which offer strong appreciation or at least appreciation potential going forward. Then you have some markets that are in transition. They're appreciating so much that the cash flow is dropping on a relative basis, and they become hybrid markets. So they shift from a cash flow to a growth market. And so you kind of have the best of both worlds. Kansas City and Indianapolis have been doing this over the last 3 to 5 years. So I was investing in Kansas City about 5 years ago when it was more of a cash flow market. Then it hit this stride and started to appreciate very strongly. And now it's more of a growth market where the numbers aren't as sexy on the cash flow side. I wish I could give you a simpler answer than that, but it really is a matter of location and timing. Where is that market in its timing or cycle?
So next question, actually, Marco from Setis. Any thoughts on real estate impacts when the ending of the buying of mortgage-backed securities by March of 2022?
Buying mortgage-backed securities?
No, thoughts on real estate impacts when the buying of mortgage-backed securities ends by March 2022.
I don't have a lot of comment on that. The reason is because the Fed will have to continue to ease in one way or another, and whether it's treasuries, mortgage-backed securities, or something else, there's always going to be liquidity in the system. we're past the point of no return. We're just in an inflationary environment. And that's going to be a fact of life. As far as mortgage rates go, I don't think anybody, it's not going to be politically favorable for mortgage rates to rise quickly. And so I don't think there's going to be much of a change in terms of mortgage rates, or even the Fed funds rate changing all that much for the foreseeable future, and I mean the next year or two. So I don't think that's a major concern. But again, stick to the formula I have here. Buy intelligently in the right markets and areas, and you'll do fine. And here's kind of the best. Here's kind of the best opportunity out there. Get as much 30-year fixed rate mortgage financing as you can right now. It's historically low in terms of interest rates. It's cheap money. In fact, it's free money, because when you factor in inflation, you're getting that money at a negative interest rate. And so if I said to you, how much of this financing do you want to acquire hard assets, real estate, which are inflation hedge, that can provide cash flow and create equity and generational wealth moving forward, how much of that do you want to buy using this historically low interest rate, cheap debt financing? The answer is as much as you possibly can. So if you're interested in real estate, investing in real estate, you should buy as much real estate as you can in locking in these 30-year fixed rate mortgages, because this is an opportunity of a lifetime. Your tenant is paying off a debt that is being devalued year after year because of inflation. It's becoming worth less every single year. So you're actually getting a rate of return on a depreciating debt that the bank is the note holder on. I don't know if that makes sense to you guys. I hope it does. But there's a real rate of return on that fixed rate debt that you're getting automatically every year because of inflation. You should get as much of it as you can, because that is supercharging your wealth creation.
Mm-hmm. And actually, the next question is a bit related, I would say, because so Nelson is asking thoughts on buying B or B plus properties, multifamily, that are not value add, low cap rates, and of course lower cash flow. So thoughts on this for one, the next 3 to 5 years, and two, how to pitch this to investors. I'm thinking that this property has lower capex expenses, and I can stretch out the cap rate because my expenses capex stay low, yet my rental income will increase.
So that sounds like a syndication question from someone looking to do a syndication. If you can find a value add multi-unit property, fantastic. They're out there, but you have to do more hunting. It's harder to go fishing right now because it's a very competitive space. Cap rates have been compressed. There's not a lot of those value add properties out there, but if you can find one that is mismanaged, undermanaged, it's a don't wanter seller, and you can negotiate a deal. In fact, that's a property I bought a couple of years ago in Florida. Is a property that needed to be improved to increase the rents, to increase the value. They're out there. You just have to really hunt to find them. But if you can find one, fantastic. If you can get it cheap enough and you can improve that property to increase the rents, therefore the net operating income, you can definitely increase the value of that property tremendously. And with the cheap financing available out there, you can definitely get yourself a really good deal. I'm not sure if I'm answering the question, but certainly that would be a favorable play if you can find it.
No, if I could, Stefan, is it okay if I jump in? I want to make sure I follow up.
Absolutely, Nelson, go ahead. If that's okay with you, Marco, because I know we've been taking really much, and you've been so gracious today with us.
Yeah. No, I love the question.
So Marco, first of all, double and triple thank you, Marco and Stefan. Stefan always has a great host, a great guest on. Marco, and I'm definitely going to get your book. So my question is it is a syndication question, however, no value add, okay, because some of the value adds is just like paying for a B property, right? A B plus property with with some cap rates. Some sellers are like, hey, I don't have to do much and I can still clean house. So let's say I look at it from the flip side. I'm not going to buy a C property in the B area. I'm going to go for a B property, B, maybe even B plus, or maybe even a B property in a B plus area. But the bottom line is, it's not a value add. It's something newer. I'm coming in with a low cap rate, right? But I'm thinking to myself, all right, my major heavy lift expenses aren't there, and I'm going to hold this thing for 3 to 5 years, right? And then I'm going to be able, I guess, I'm thinking the word would be, I'm going to decompress this cap rate, right? Because I've got it. I don't have any major lift to do. And 3 to 5 years from now, let's just say 5, I'm going to have a lot of rent bumps in there, just normal rent bumps. I might even have specials and sales and what have you, but I'm going to have those normal rent, well, maybe even above normal rent bumps. What are your thoughts on that, based upon what, well, your knowledge?
Well, the only way to raise your cap rate is to lower your expenses and or increase your rents. So if you're buying a property and you have the ability to lower the expenses and or increase the rents, you'll increase your cap rate.
Mm-hmm.
That doesn't, however, on residential property, which are 1 to 4 unit properties, not commercial, meaning above 5 units, that doesn't increase the market value of that property, because those properties are valued on market comparables, sales comparables within the area.
Huh.
This is where larger multi-unit properties really shine, is when you can buy a property that is underperforming, meaning that you can go in there and increase the net operating income, again, through lowering expenses or increasing rents. And often the way you increase rents is you improve the property, you provide value add, you renovate and upgrade that property to increase the rents. You increase the net operating income and you increase the market value of that property, because those are appraised based on the net operating income, not on sales comparables around the area. So if you're talking about residential real estate, 1 to 4 unit, if the cap rate is low, you either have to ask yourself, can I do better looking in a different area, different neighborhood, or even a different market? Or B, can I do something with that property to actually increase the rents so I can increase my cash on cash return? Is that what you're getting at, or am I missing the core question?
Well, no, it was more on the multifamily side, but basically it's that. So it's what additional value, what additional ways can I generate revenue if my expenses are about as low as I'm going to get them, because it's a newer property. And what other ways can I squeeze out another quarter out of the property, basically? How else can I squeeze another quarter out of the property?
If the rents are already at market and there's no way to increase them, then you basically have a glass ceiling above you. So unless you can do something to add value to the property that justifies increasing the rent, there's very little you can do, because if your expenses are already squeezed down as low as they can go and your rents are as high as they can go, there's no margin in there to increase value or increase the rents. You have to increase value to increase the rents. So that doesn't sound like it's an opportunity. That sounds like you're paying full market value for a property based on that.
Mm-hmm. Okay.
Marco,
thank you very much.
I guess, Marco, maybe, like, if I'm understanding correctly, like Nelson's question is more of, okay, there is no value add, that's kind of assumed, but given like all the inflation and sort of, rent growth discussion that you had I saw earlier, like, sort of, is it the time to actually buy something that is more turnkey, that is, less capital expenditure on sort of appreciation bet and rent growth bet, where you would also kind of effectively raise your cap rate this way, right? So you kind of, it gets a little bit constant. So sort of betting on rent growth, that's not going to translate to property value, understood, but it's going to translate to revenue, and there may be other price appreciation, considering the perhaps massive inflation. I'm not sure if I'm understanding correctly now. So it's more like, it wouldn't be the typical strategy in another time, but I guess it's more of an appreciation bet question at the current moment. I feel, at least that was my understanding, Nelson, if I'm correct.
Yeah, the situation,
You're correct 100%.
So I'm going to comment. I'm not sure if I'm answering the question, but if you look at everything that's going on based upon what we, talked about with all these slides, is we're pretty much in a seller's market in practically every market, short of maybe some, like San Jose, San Francisco, some other places. We're in a seller's market, which means that you don't have an advantage being a buyer trying to get into a market looking to buy investment property. You're not going to find deals. Odds are you're going to be paying, at or very close to fair market value. Maybe in some cases, you're going to be paying over market value if it's a competitive bidding situation. So to try and find a deal, a true deal that is below market value is very difficult. So this is why it's important to, regardless of what you're buying, whether it's a larger multi-unit property or a turnkey rental property or duplex or whatever it may be, to buy properties in good markets and good neighborhoods that make sense the day you buy them, meaning they cash flow, they have a favorable cash on cash return that meets your investment criteria, and ideally position yourself in a market that has future growth potential, because you're not going to be quote unquote buying low. It's going to be hard. I'm not saying you can't do it, but it's going to be harder. Like I said before, the fishing and the hunting effort that you're going to put in is going to be much more today than it was 10 years ago, for sure. In 2012, you could have thrown a rock in any direction and hit a good deal. They were just all over. We were at the bottom of the cycle in pretty much every market across the country. It was a pure buyer's market. Now we're at the height of a seller's market. It's much harder to find those types of deals. So you're going to have to put in a lot more effort and a lot more work to find it, or just pick a good market, find a great property in a good neighborhood that makes sense, cash flows, has good financial metrics, and have a long-term investment horizon, knowing that you're going to be holding that property for 5 to 10 years or forever. And when I say if it's anything less than forever, you're not actually selling that property. You're just doing a 1031 exchange into another market to leverage up your portfolio. But you're never going to just sell for the sake of selling and just take the cash and go do something else with it, because good luck finding something else that's going to compete with real estate today, unless you're looking for asymmetric returns in the cryptocurrency world, but that shouldn't be where you put all your eggs either. So just, if you need help, my team can help you. But at the end of the day, find the best deal you possibly can in the market that makes sense, that is going to give you returns today, stability today, and upside potential tomorrow. Unless you're a hunter and you've got time on your hands and you've got the ability to go and search and find markets and farm areas where you can find a deal, kind of a don't wanter, a distressed seller that's willing to sell below market value, where you can get into a deal that has built-in equity or the ability to improve a property, whether it's a large multi-unit or a single-family home, to increase its value, market value, and or rent potential. So kind of a general question to your answer, or kind of a general answer to your question. Yeah.
Okay. And next question by Ajit is what kind of debt is best buying large commercial assets now, as in fixed or float or bridge? I guess you partly answered this question. So trading it down the road would be easiest, so loan gets assumed by future buyers.
What is the best kind of financing?
Yeah, in terms of fixed, float, or bridge. Well, bridge can be.
If you need bridge, you need bridge. But if you don't need bridge financing, locking into a fixed rate mortgage today with rates as low as they are, is a hands down winner. You can't go wrong because rates are pretty much at a floor. So just lock in as much fixed rate, low fixed rate financing as you can. The only exception to that is if you need for a short period of time, like, over the next 6 months to 5 years, an interest only loan, because the deal is, you can build appreciation into it. Like you could not appreciate, you can build equity, like you could build value into it, or you're in a market that has a very high probability of appreciating, but you don't have the cash flow up front, then get an interest-only loan where you can convert later, modify that loan into a fixed-rate mortgage loan. So you have the cash flow today, you let the property appreciate in value, and then later you can lock in to a fixed-rate mortgage, or you can refinance into a fixed-rate mortgage. But nobody knows what the rates are going to be 5 years from now, but we have a pretty good idea of what they're going to be for the next 12 to 24 months.
And so another question, actually, Ajit sent it to me in private. So talking Florida, how is rent growth now on West Coast? So I guess he means East Coast, or I'm not sure, actually. Would you like to speak up, Ajit, actually?
Yeah,
or I guess how is,
yeah, West Coast of Florida, I meant.
West Coast of Florida. Okay, understood. Got it. Okay. So how is the rent growth, I guess, on the, was it not the shoreline of Florida?
Are you in the Southwest, like Cape Coral, like the Southwest Florida market?
I'm looking more in terms of either Tampa or St. Petersburg, general area.
Rent growth is very, very strong. Tampa has been a very, very strong market. However, just be aware there's a lot of new construction going on there. So you're going to get to a point where there's going to be enough inventory to meet the demand. So there'll be a point of equilibrium, and that'll slow price appreciation down, and potentially even slow down the rate of rent increases, like rent growth. But it's still a healthy market. It's just tough to find inventory there. It's very tight. As you go further south, because we're in about 5 markets south of Tampa and St. Petersburg, starting from Cape Coral, Florida, and going north through the Port Charlotte area, Northport, and whatnot. Those areas are growing very strong, very high job growth. So, and those are all new construction. So I don't know what you're looking at, but the Southwest Florida is very strong. Tampa's good too, but it's just been very tough to get inventory there.
Yeah, we're looking at 100+ units in the Tampa market, but as the broker suggesting that we do a rent growth pro forma bump of almost 25–30%. I thought that was overkill, but I'm not very sure if it can handle that kind of rent growth for year 1.
Well, if you owned the property and you had that kind of rent growth, my hat's off to you. But if you don't own the property and you've seen that rent growth, I wouldn't be chasing properties that have already had that rent growth, unless you can, again, buy at a price that gives you the financial returns that meet your investment goals. So, you have to have a favorable rate of return, otherwise it's not an investment.
It does cash flow from a debt aspect. It's got about 1.6 on the DSCR, but I don't know if I should be projecting forward rent growth.
1.6? Your DSCR is 1.6?
Going into the deal.
You're kidding me. I that's very high. There's something missing there. I mean, if you don't want that deal, I'll take it. That's a very good.
We are chasing it, but the broker suggests that we are being overly conservative on the forward rent growth. They suggest on a 5-year rent growth of totally about 70 to 75%. I don't know if that is realistic or BS.
Is 1.6 real numbers, or is that forecast?
No, I'm talking about forward rent growth on a 5-year trajectory, total rent growth.
Well, it's hard to predict 5 years. It's much easier to predict 1 year expected rent growth. I don't know where it's located, but you could probably reasonably expect a 5% rate of rent growth, but I wouldn't pro forma or budget or forecast more than 10. That would be unrealistic. I mean, it could happen, but I wouldn't base my purchase decision based on a 10% rent growth. The only way that would happen is if the rents are actually 10% below fair market rents for the area right now. That's the only way you can get into that deal and know that you can bump the rents and get an increased rate of return on that property. What you need to do is you need to do your research and look at what market comparables are. You need to see what is actually renting in that building and in that area, and what you could raise your rents to. You have to get comps, like comparables.
Yeah, we did that. We currently own close to 1,000 units in Texas, and we're trying to explore into Florida markets. We have some boots on the ground on the East Coast, but I did rent growth study on the comps. There is room. The property is currently 100% occupied. We're assuming a loan that's much below the current rates, which is good, but considerably, since we're going in at a 65% leverage, we have a pretty heavy lift on the equity. So we're trying to see if it is worth it to go into it or not.
You need to do your research with local market information, local data, local comps. It all has to be as tight as possible. So if you've got boots on the ground that can help you with that, that's great, because you're going to need real current numbers in the local area.
Thanks.
You're welcome. Don't feel like I really helped you on that one, but yeah, you're going to have to dig deep on that one.
Yes, and Marco, just before we wrap up, so your company, Norada Real Estate Investments, so is it exclusively in the single family turnkey space, or just to understand and kind of being an operator of turnkey properties for other investors, or what is exactly your business, and like just for our audience in terms of, and then I'm going to go to the next question of like how people can reach to you as well.
Yeah, no, I appreciate you asking. What we predominantly focus on are residential properties, which are one single unit, like single family homes, duplexes, triplexes, and fourplexes. All those are considered residential real estate. 80% of what our investor clients purchase are single family homes, and those are either new construction or newly refurbished properties that are completely turnkey. They're like new, but we provide a free service, so we help you identify the markets. And provide you with the resources, the knowledge, and the properties that you need to invest in about 20 to 25 markets. We're in about 25 markets on and off, mostly on the eastern half of the United States. And so, so anything you need, from the properties to the financing, the property management, title companies, inspections, asset protection attorneys, tax advisors, anything you need, we have available to you through our network. And we have an investment counselor that will be assigned to you. The investment counselor is your primary point of contact. They're going to basically answer all your questions, guide you, help you choose the right markets and neighborhoods, put in properties in front of you, help you with the financing, pretty much anything you need. And all that value comes at no cost. So I like to say it's a free service. I don't like saying free, but there's no cost to you. There's no obligation. We've been doing this for 18 years. So hopefully that answers your question, Stefan. And you're muted, by the way.
Yeah, it does. So Nelson, just wanted to ask a quick question. Yeah. Mm-hmm.
Yeah. So, and Stefan, thank you. And Marco, thank you. This last one, dealing with some issues. In your kind of turnkey single family home business, are you also involved in the short-term rental aspect as well?
Interesting you asked that. The short answer is no, we're not, at least not yet. I actually am on the tail end of being the guinea pig on completion of a high-end, what they refer to as an extreme Airbnb in Florida. And it's going on the market, I believe this weekend, this weekend. So based on the success of that, I might be offering a short-term rental program or solution for investors as well. But that's not something we ever ventured into, just because most investors just like that predictable 1 and 2 year lease, very passive, professionally managed property. I know the benefits of short-term rentals. There's also some headaches that come along with it, but it is something that I am actively looking at. It is something that I'm myself being the guinea pig in. I've got the team to do it. So based on the success of that, we might actually be announcing something come early next year.
Okay. I mean, we have Airbnbs, and not an extreme, I'd say above, it would be pushing on the luxury side.
Okay.
In Florida.
Cool. Well, I hope it's going well. What city is that in?
In South Florida.
Okay. So my experimentation is in Orlando. It's actually 20 minutes from Disney World, just because I know I have constant traffic flow there. You know, there's
Celebration.
No, it's in Davenport.
Okay.
Yeah. So, but you know, that location is more so important with Airbnb than it is with traditional rentals.
Yeah. We're Miami, Fort Lauderdale.
Yeah. So yeah. So you know, it might be an option that we offer. The thing is, you can take any of the rentals that we sell right now and turn them into short-term rentals. It's just, you know, how what your occupancy rate is going to be is dependent upon the location within that market. So if you're close to, you know, certain attractions, theme parks, or you know, a beach or whatever it may be, you're going to have higher occupancy than if you're like way out in the country. So,
right. Well,
so
even, and there's plenty of people, believe it or not, who enjoy being way out in the country.
Yeah, I'm sure.
I'm sure. There is an interesting,
yeah.
But I digress.
That's good. Well, congratulations. It's good.
I'll be reaching out to you.
Sure.
Okay. Well, Marco, thank you so much for taking the time today and answering all our questions. And what is the best way for people to reach to you?
Yeah, really just our website that you see at the bottom of the screen. Well, I saw it right there. NoradaRealEstate.com is our main website. That's kind of the home base, if you will. That's the best place to get in touch with my team and I. And then as well as you can also find our podcast there as well. But the podcast is PassiveRealEstateInvesting.com. So either one of those is where you could reach my team and I.
Great. Thank you so much. And thanks everyone for joining us today.
Yes, thanks everyone. Thank you, Stefan.
Thank you.
Thanks.